Can you hear me, sir?
Good evening, sir. Yes, sir. We can hear you, sir.
Oh, Prof. History, how far now?
Fine, sir. We thank God, sir.
Hey, I've heard your voice. You know you have a unique voice. Yeah, well done. It's
Today is not
thank you.
online yet, too.
Yes, I know. We have to hold on for the students.
Okay, sir.
Thank you. Yeah, Professor Deji. Yeah, I hope you are good, sir.
Yeah, it's online as well.
Okay, thank you so much.
Oh, President,
So wait for the students, please.
Yes.
We are online. I will waiting for the students, sir.
Yes, we'll wait.
Okay.
All right.
Hello, Prof. Hello, sir. Good
Hello.
evening, Mr.
Hello, Prof.
Kennedy. Okay. Mr. Kennedy is online.
Prof. Israel.
Yes, sir. Mr. Kennedy is online.
He's not there now. Nobody is there.
No,
Okay, Prof. Kenny has sent her.
Yes.
All
So
right.
we can start the class now.
All right. Okay. I'll let him.
Yeah, welcome, Mr. Ken Richardson. I hope you can hear me. Yeah, we've actually been waiting for you. I mean, I just had to log out for some time. Now, thank you. Sorry, the last class I was a bit down. The last class, I'm sorry. And one or two issues, which I know was not too much last time in the last class. Yeah, so let's add today's class. Now, today's class, you question last time, but I said I'll respond to anyway. But I will surely respond to this. Now, let's let me share the screen today. Now, let me share the screen. Now, welcome. Now, so Mr. Kennedy, Mr. Kennedy is more online.
The network has logging out.
Yes, I understand that. It's serious. It's let's wait for him.
We need to wait for him.
We need to. Yeah, welcome back. Welcome back, Mr. Actually trying to wait for you. Sorry. So, let's look at today's class. Today's class is on. If you look at today's class, we have cash operating, or we call it working capital cycle. Let's talk about the cash operating cycle, the working capital cycle. When a network is unstable, so we have to make the network that way. So let's look at this. Now, for you to have a good organization, for you to run an organization, you must sure that the business, all the activities of the business are geared to Okay, I'm so sorry. The network logged me out. Yeah, I'm sorry. So, Mr. Kennedy, I'm sorry. So let's quickly continue on what we are doing. Let me quickly screen share. Now, so now let's look at it. Now, I said when you are running an organization, you must ensure that the organization that you are running, everyday need of the organization are taken care of. If not, you are going to have an issue, a going concern issue of the organizations. When we say going concern, it means that in the foreseeable future, there is likelihood that the business will not exist again. Now, if you want to now ensure that you have a good a business that is what that is not having an issue as per the going concern, then you must take care of everyday needs. Now, that everyday need is what we are we want to center our explanation on now under cash operating cycle. Now, look at it. An important way of assessing the adequacy of working capital. Our focus here is working capital. And when we say working capital, these are the amounts that are using to run everyday need of the organization. You can't say because you are running an organization, you will not have some cash on hand or an amount that you have to be using for everyday need of the organization, because there is no way every day you will need an amount to run. I guess what I'm saying now. To know the appropriateness of that amount, I get what I'm saying now. Then that's why we are looking at what working capital cycle, which also called cash operating cycle. Now let's read what we have here. So the focus of this topic is more of how do we know how do we know how much per time we need to have on hand as what as our working capital. I hope I get what I'm saying. And we want to also know how do you determine the length of time between when you produce and sell and what you're receiving from your debtors. When you produce fruit, I get it, you are going to sell it. Mostly you sell some of them to debtors. I get what I'm saying. That you want to look at the distance, between when you purchase your raw materials and all what you use in producing. I get in the time between that period and the period when you now have to sell that product. I get in and receive your money back. It's a time lag. I actually got I actually what I actually got raw materials from the suppliers. I convert those raw materials into goods. After converting it, I'm able to sell it and sell it to debtors. Debtors take some time to pay me back. I get it now. What's the time lag between that period in which I got from supplier, the raw materials, and when I receive my money, when after I've sold the product to debtors. So that period is a cycle. I guess we call it what the cash operating cycle or working capital cycle. Now, what's the implications of this period? The implication of this period is that it will help you to know how much per time you need to hold. I get me as your working capital. I get me now, and it will help you to note how do you manage those elements of the working capital. When I mean working capital now, those items that you use in running the everyday activities of the business. It will help you to know how to manage it very well. And apart from that, it will also help you to be able to achieve your the profit motive of the organizations. Now, if you look at it, they say an important way of assessing the adequacy of working capital. How adequate is that working capital, that amount that are using to run the everyday activities of the business? And the efficiency of the working capital management. How efficient are you in managing or handling that working capital items? I get what I'm saying now. Is to calculate the length of the cash operating cycle, also called the working capital cycle. For you to know how adequate your working capital is and how efficiently are you be able to manage the working capital, then you must be able to calculate the length of the working capital cycle. And I told you the other time that the working capital cycle or the cash operating cycle is a cycle between when you receive when you collect the supply from your creditors. I guess me now, and what you convert those supply. Let's say for instance it's bakery now. Take for instance, you are running a bakery business and you want to talk about the working capital cycle of a bakery business. Is a cycle that encompasses your when you receive flour from your creditors. Those are your suppliers. After receiving it, you put it in your store. After putting it take a day, it takes some days to put it in your store. After you stay in store from store, you now convert it to work in progress. That's what you convert it to what? To semi-produced product. After work in progress, then it becomes a finished goods. It also takes some time to do that. After it's also finished goods, yeah, you now sell it. I mean, sell to debtors. I get him. After you sell to them, it takes some time for you to sell to them. After selling to them, it will take some time for them to want to pay you back. I get him now for what you have sold to them. You have now received it, then you now return back your money back to your creditors. You now pay the creditor that supply you the material, the flour. Can you see the cycle? The cycle goes like that. That's cash operating cycle, or call it working capital cycle. You need to note that this period can be 10 days, can be 20 days, can be 30 days for you to complete this cycle. Are you getting me? So that's cash operating cycle. Now, your ability to know the number of days this cycle will move is very key when we talk about cash operating cycle. I hope you understand what I'm saying now. So it's very, very important for you to know it as a business owner. I get it. So that's that. So if now look at it, this cycle is the average length of time. Can you see between paying suppliers? That's the person that supply me the flour. That was the average length of time. The cycle between paying time it take you to pay your supplier for goods and services you received and receiving cash from your what? Customer for what? For sale of the finished goods or services. That length of time between when you the average length of time between paying suppliers for what? For the goods and services you receive and what? And receiving cash from customers that you sell your goods to is a cash operating cycle. You now tell me between Just Right and Julius Berger, you want to see what is their cash operating cycle like? They will have different cash operating cycle. The number of days to turn around cash, I get what I'm saying now, in Just Right or ShopRite, which is happen to be a grocery store, is different from that of the Julius Berger, which happen to be a construction firm. Because in Julius Berger, you see that when they do the road, it takes some time, a longer time before government pays them back. So that means that they will have a longer a longer cycle. I guess in a why ShopRite? If they sell to you in ShopRite, I hope I get what I'm saying. That they will not sell to you as a debtor. You must pay your cash. You must put down your ATM. It means at the time it takes them, I get to get the money back from you. I get me. It's very faster than when it is what is Julius Berger. Can you not see? So a manager in each of these companies I mentioned now must understand the kind of environment in which they are operating. A Julius Berger manager must understand the way the cash move. How do they get how do they get their supply from creditors? How do they convert it to services or goods or services? How do they get their money from from government as their major debtors and so on? What's the length of time? They must know it so that they can know how to run their organization. While the manager in ShopRite must also understand the terrain of the way they run their business and the way cash moves, so that you'll be able to plan effectively and efficiently for the cash. It means that you have a good cash management. I hope you get what I'm saying. That is that about the cash. So you should have the background of this cash operating cycle. There is a way that a manager used to manage their cash. I get in such a way that you want to know how much cash or how much working capital do I need to hold per time. I get what I'm saying now. So how do I handle my debtors? How do I handle my creditors? Am I able to know whether and what there is the period at which I'm getting my money from my debtor is what is unduly prolonged or not? All this will be what will be thrown up when you're talking about the cash operating cycle. I hope you get what I'm saying. Now, there are three main elements in the cash operating cycle. Now, what are the three main elements in the cash operating cycle? The first one is the average length of time that inventory is held before it's used or sold. So that's cash operating cycle. Those three key elements is that you need to get your supply from your creditors. Let's say, for instance, flour. Now, if you get a flour from creditors, if they supply you, it will take time for that flour to be converted to final goods and services. I get final flour goods, which is bread, before it can be sold out. I hope I get what I'm saying now. So the implication of this is that one of the components of the cash operating cycle is that you want to know the number of time or days or months it will take those that items of inventory to be held before it is converted to finished goods. That's one. Two, the second element is the average credit period taken from suppliers. How many is the number of days? How many is the number of days that we plan to pay back the supplier of the flour? It can be 30 days, it can be 2 months, it can be 3 months. So that's another element, key element of the cash operating cycle. Because suppliers will give you different number of what, it's based on what agreement you have with them. I get what I'm saying. So after knowing the number of days the inventory you want the supply do is going to stay before it's going to be converted to goods and services, then you need to also know the average time the what you need to pay back your suppliers. That's another key element of the cash operating cycle. Now the third one is what the average length of credit period taken by the what by or given to credit customers. You need to now look at those people that are now buying the bread from you. How many days are you giving them? Those people that buy it on credit, that purchase on credit, how many days are you giving them to pay you back your money? I hope I get what I'm saying now. These are the key three elements of working capital. If you want to look at November 2014 question 1, November 2014 question 1, it basically borders on what on working capital. I hope I get it. So look at it. The working capital cycle will explain to you that it's a cycle that helps you to know how to manage your cash in the organization and even the working capital most importantly. And to get that working capital cycle, you need to look at what's the period between when you are paying back your creditors for the goods they supply you and the period between that time and the time you receive your money from those people you sold goods to. That period between interval can be 10 days, can be 20 days, can be 50 days, is a working capital period. I guess what I'm saying, a cycle. And that cycle is what it's different between, it varies among organizations. It depends on the kind of organization you find yourself. And the elements that will help you to know that number of what or cycle, days in that cycle. I guess what I'm saying now are what one, the number of days, average length of time that your stock or inventory was held or is held before it is used or sold. Two, the average number of work credit period taken from what? From suppliers. And also three, the average length of what or credit period given to what? To credit customers. So if you now want to get that cash operating cycle or number of days in that cycle, I get it, so that I will know the number of days between when I'm paying my creditors and when I'm collecting money from my debtors. How do you do? Now say the operating cycle is measured as follows. Look at the way it measures. In the exam, you should know that to get that cycle, number of days in that cycle or weeks, it can be measured in weeks or months or days, depending on what the examiner is saying. Now, if you look at it, average inventory holding period. I told you this is the inventory holding period. That's the number of days it takes those inventory to be converted to goods. I guess what I'm saying now. That's it. You now add average or trade receivable collection period. That's the number of days it takes you to collect your money. I hope I get what I'm saying now. From those people that you sold it to. I get me. That's the second attempt. That's it. If you add those 2 days together or weeks or months together, it will give you this. You now less average period of credit taken from what? From supplier. That's the number of days it takes you to pay your money back to what? To supplier. I hope I guess what I'm saying now. So if you do that, if you less it, what you have is what is your operating cycle. I mean, this is your operating cycle. It means that if it is 20 days, that's 20 days that will take you to what? To what? To get what supply from your creditors. I mean, and paying back your creditors and what? And the receiving from your debtors. That cycle, that is that days, weeks, or what or month. The operating cycle, that's the operating cycle. I hope you understand that what the examiner would now ask you is that how do you complete this operating cycle? Please don't forget. There are basic three elements of this operating cycle. The first is the average inventory holding period. That's the time it takes you to hold that flour or stocks in your store before you convert it to goods. Two, average trade receivable collection period. That's when it takes you to collect your debt, what you sold. I mean the money back from your debtors. That's to three, and the average period of credit taken from suppliers. I hope you understand that now. So if you had the first two and less the last, you get the operating cycle, which is very key in cash operating cycle. So they will ask you to compute this. Please don't forget that this number one, this average inventory holding period can also still be subdivided. I get me now. Because if you say average inventory holding period, I get me, there are still some element of it. But basically, those elements, I will see, obviously look at it subsequently. Now, let's look at it. Now, if you look at it very well, if you look at it very well, he said the working capital cycle measures the time taken from the payment made to suppliers of raw materials to the payment received from customers. I hope you understand that now. So that's key. Suppliers and customers. The cycle between the two, the days between the interval is working capital cycle. In a manufacturing company, this will include the time that now that's number one I told you. These are the elements of it. Because I told you the three key things are this average inventory holding period, average trade receivables period, and average credit taking period. But this inventory holding period is also subdivided into three parts. Because in the exam now they can subdivide it. I guess what I'm saying now. That's the number of days it takes you to hold the flour or store. I guess before you convert it to goods. That number of days now is a combination or compendium of whatever three things. Look at it. The first element of it is raw materials are held in inventory before they are used in production. That assuming they supply you the flour, it should take some time that the flour will stay in the store before you start using it in production process. That is a component of that number one that I talked about. This is average inventory holding period. It means that the number of days that the raw material will stay in the store. That's 1. 2. Then another element of that inventory holding period is the number of days the product takes in the production process. How many days does it make you to convert it? If it makes it 2 days for you to convert raw material to production, it has taken some days in store before you now convert it to production. That's another component of the inventory holding. So the last one is finished goods are held in inventory. After you have now finished it, it's not immediately you sell it out. You still put the finished product like the bread in store before people can start coming to take it. That's also finished goods are held in inventory before being purchased by a customer. This addition of this 1, 2, 3 is what will give you this. Look at it. It's what will give you this inventory holding period. I hope you're getting it. So in the examiner may not give you directly this inventory holding period. They will give you the raw materials holding, the work in progress, and the finished goods holding period. So the addition of that three things, which I highlighted earlier, is what will now give you this inventory holding period. But if the examiner give you directly, so be it, then you are good to go. Just pick it and use it straight. I get me now. So these three elements comprise is what makes what the inventory holding period. I hope you're following. Now, let us now calculation of a cash operating cycle. Those elements now, how do we now calculate them? There are three basic elements apart from the subdivision of the inventory holding period. The three elements are, how do we know this number of days of inventory holding period in the question in the exam? How do we know the number of days for this average trade receivable collection period? How do we know the number of days for this average period of credit taken from suppliers? All these three, we have to know them. I hope I get what I'm saying now. So let's look at it one by one. How do we compute the number of days? Now, the first one, the average inventory holding period. To know the average inventory holding period, how do you know it? The average inventory holding is the number of days it takes the flour or store to stay in the store or to be converted to final goods. I guess how many days is in an average inventory? What's the average inventory in the company at that time? Divided by the annual cost of sales times 365 days. 365 days in a year, you are expecting it in a year. I guess what I'm saying now. Sometimes it can be in days. I guess me. But in this case now, you convert it to how many days in a year. So how many days in a year will your flour or your store, let's assume flour we are talking about, will your flour be what? Stay before it becomes a finished goods for sale. I guess me. That's average inventory holding period. Just say the average flour in the store on the average. Now, if you want to get the average, is opening stock plus closing stock of flour. Opening stock at the beginning plus closing stock at the end. Add it together, divide by 2. That's the average inventory. But if they did not give you opening and closing stock, if they just give you only closing stock, just pick it as your average. But if you are having opening and closing inventory of the flour, add it together and divide by 2. That will give you the what? The average inventory divided by the annual cost of sales. What is the cost of sales? You know the meaning of cost of sales, opening stock, you know the way you got the cost of sales, they'll give you. If you divide it and times 365 days, that will give you the number of days that the what that will hold the inventory in store. I hope you are getting it. That average inventory holding period. Please don't forget that. Now, let's now look at the second element of this. You know, the second element is what? Is average trade receivable collection period. That's the days it takes you to what to collect your debt from your debtors. I hope you get what I'm saying now. Now let's get it. Calculating the average receivable collection period. The average period for collection of receivable, that's of debt, after you sold, average time it takes you to collect your money back can be calculated as follows. Average receivable collection period is average trade receivables. In this instance there, so if you give opening and closing what receivables, add it together and divide by 2, that's your average. But if the examiner just give you only average, only what closing event receivables, you just choose it and divide it by the annual sales. You multiply by 365 also. That will give you what? An average receivables collection period. Now, the last element of this is calculation of what? Average payable period. That's the number of days it takes you to pay back your what? Your supplier. That's your creditors. Now, the average period of credit taken from suppliers before payment of trade payables can be calculated as follows. How many days it will take you to pay back your suppliers? In this instance here now, to get that average payables rate will also be average trade payables. Now, the average trade payables now, if you add it together, the opening and closing payables, you divide by 2, it give you the average payables. But in the exam, if you are not given that average payables, opening and closing, just use the one you are given as your average payables. Divide it by the annual purchases. You know, when you are talking about receivables the other time, we use what? Annual sales. When you're talking about what? Our average payables period, we use what? Annual purchases, 365 days. So these are the key 3 elements. Don't forget that inventory holding period is also subdivided into 3, assuming you are given in the exam. Now, if possible, average inventory, receivables, payables, balances should be used to calculate the ratios between the year-end balances. Might not be the ratios because the year-end balances, these are the opening and closing inventories, what you have to get and divide by 2. Because what? Because the year-end balances might not be representative of the average balances. So, in the period, average balances are usually calculated as the average of the balances at the beginning and at the end. I told you opening and closing of those balances. If it is inventory, opening and closing of inventory divided by 2. If it is receivables, opening and closing of receivable divided by 2. And if it is payable, opening and closing of payables divided by what? Divided by. That's what you use as an average in the computation. Else, if you are not given opening and closing, just use the one you are given in the question. Now, the year-end balances are used when opening balances are not given and are not given, and average balances cannot be calculated. Now, the year-end balances are used. That's use the year-end balances are used when opening balances are not given. That's if you are not given the opening balances, and average balances cannot be what? Calculated. And when the average balances, so that's it. You should use the average, but if the average is not used, then you'll use the closing balances. That is that. So let's go on. Let's look at an illustration of how to compose it. How to compose it. Sorry. Let's look at an illustration. Now, the following figures have been extracted from a company's account. What are these figures? Now, statement of profit or loss. They are given a statement of profit or loss. What's the sales? 1.2 million. I hope you can see it. Sorry. Sorry today. Now, the sales is 1.2 million. Cost of sales is what? Opening stock is what? 250,000. Purchases is 1 million. That's 1,250,000. Closing inventory is 250,000. If you less this, you have 1 million. 1.2 minus the cost of sales of 1 million, you get what? Gross profit of 200,000. Now, You're now given statement of financial position. What are statement of financial positions? Now, these are the extract. Trade receivables were given 400,000. Trade payables were given 166,667. You're now asked to compute the what? Cash operating cycle or working capital cycle. I told you the first one is what? Average inventory holding period. And what is the formula for finding the average inventory holding period? That is the average inventory over annual cost of sales. In this case now are we given, what's the average inventory you are given? You know, it's only, you can see opening stock is 250, closing stock is 250. They give you the two. If you add the two together, you divide by 2, it still give you the 250. That's the average inventory is 250 divided by what? Annual cost of sales. If you look at the cost of sales is 1 million. 1 million, that's 250 over 1 million times 365. How many days is that? 91 days. 91, it takes you 91 days. It takes 91 days for the what? For the inventory to be converted. I mean, the inventory for us to hold our inventory before it becomes a finished goods. That is what average inventory holding period. You know, in this case, that they have not was subdivided into those 3 elements I told you. In these instances, they give you directly. I get it. So you just divide your average inventory by what? By annual cost of sales and multiply by 365. You know, why we are multiplying by 365 is I want to express this in days. And how many days in a year? 365 days. That's whatever you get now is the number of days it takes us to hold our inventory, to hold our file before we convert it to what? To finish goods. Now that is that for the first one. Now the second part of it is average receivables collection period. That's number of days it takes you to collect your money from those you sold goods to creditors. I get it. For you to get the average receivables collection period, it will now be average receivables over annual sales times 365 over 1. That means that I need to go back and get what is even my average trade receivables. If you look at trade receivables, you are given to be 400,000. You are not given opening and closing. You are just given an average receivable. You have been told the receivable is 400,000. So if the receivable is 400,000, so what are you going to do? 400,000 over annual sales. You know very well that my annual sales were 1.2 million. So if is 1.2 million, it will now be 400,000 over 1.2 million times 365 days. That it takes 122 days for you to receive your cash from those people that you sold it to. Now, average payables period, that's average trade payables over annual purchases times 365. If you look at what was the payables in the extract of the statement of financial position, is 166,667. While what is the work purchases, which is 1 million, that's times 365, that's 61 days. In this instance, I've been able to get what is my average inventory holding period, which is 91 days. I've been able to also arrive at my receivables period 102 days and my payable period will be 91 days. Now let's now look at what is now the cash operating cycle. Cash operating cycle will now be average inventory holding period 91 days. Average trade receivable collection period is 202. If you add the two and you now let average period of credit taken from customers or from suppliers, I'm sorry, if you less it, you have 152 days. This is your cash operating cycle. This is the length of period between when you pay your suppliers and when you receive money from your creditors for what you have sold to them. I get it. If I know this period now of 152 days, it will inform my decisions of how well I'm going to manage my cash. I get what I'm saying, that when am I expecting to receive my money from my debtors, and when am I expecting to pay my creditors their balances, and how many days will it take me to hold my inventory in store. All these are decisions that can be made using this working capital question. So if you look at the analysis there, comment on that illustration I just finished. Now you can see each of these period calculated give insight into the working capital held in relation to the activity level of the business. So each of those figures we arrived at for those 3 things, it gives us an insight into the working capital of a company. I mean, in relation to the level of activity or level of production of that company. Let's look at the first one. The company in the above illustration had inventory of 250,000. and cost of sales of 1 million. Yeah. In other words, it has enough inventory to supply 3 months cost of sales. You have enough inventory to supply how many months cost of sales? 3 months cost of sales. This is implies an average inventory holding period of what? Of 3 months. Now, what does that mean? It means that the company in the above illustration has inventory of what? Of 250. Obviously, you have 250,000 naira inventory and cost of sales will be 1 million. In other words, it means that the cost of sales is 1 million. In other words, it has enough inventory to supply 3 months what? 3 months cost of what? Cost of sales. I get it. This implies an average inventory holding period of 3 months. This 1 million divided by 3, what does that give you? I guess what I'm saying now. What does that give you? So you want to look at receivable. 1,000 naira per month. I get what I'm saying now. Sales are 100,000 naira per month. Let me first analyze the second information for you. Let me analyze second information. The company sales in the year were 1.2 million. It means that for every month, the sales is 100,000. 100,000 times 12 is 1.2 million. Is it not? Of which it has yet to collect how much? 400,000. How many? It means that for every month it's 100,000 sales. Now, and they are owing me 400,000. What's the implication? This implies that it is taking about 4 months, because 100,000 in 4 months is what gives me this what? This 400,000 was receivables. Now, what's the implication? This implies that it is taking about how many months? 4 months, or the one, how many days? 122 days. Because 4 months is like, what times 30 is 120. 122 days shown above, because when we computed, we got 122 days for the receivables collection period. Now, to collect receivables, it means that it will take me 122 days or 4 months to collect my receivables back. I guess because how many sales in a month do I make? 100,000 naira. 100,000 times 4 is what? Is because I got 100,000 by saying 1.2 million divided by 12. 100,000. 100,000 times 4 give me 400,000, which is equivalent to what? What they are owing me. It simply means that this implies that it is taking about 4 months for me to get my money back. I guess what I'm saying. So for me to what? To get my money back from what? From the debtors. I get me to collect receivable as sales is 100,000 per month. I hope you understand the implication of that 122 days now. I get what I'm saying now, because 1.2 million was total sales, and per month is 100,000, and they are owing me 400,000. It means that 100,000 in 4 places. That's 4 months. I get me sales is what is terming. It's how we term as my receivables. I get me. So it takes me like 4 months for me to get my money back from those people that I sold it to. Look at this. The company's purchases in the year were 1 million. We go and check it. We are looking at creditors' payment period now. It's 1 million naira, of which it has yet to pay how much? 166. And our payables is 166.67. This implies that it is taking how much? About 2 months. That's 61. How do you get the 2 months? 1 million is the what? Is the purchase for the year. If you divide 1 million by 12, I hope you're getting me. It will not be up to 100,000. I get me. It will maybe 80-something thousand or 83,000. I get what I'm saying, per month. It means that if I multiply 3,000 per month, that will give me the 166,000, which 607, which happens to be the what? The payables in the period. That means that my payable is equal to 2 month purchases. I hope you're getting me. My payables is equal to what? 2 months what? 2 month purchases. Can you now see? So it takes me how many days, how many months? 2 months for me to what? Equivalently collect to pay my what? To pay my credit. I hope you are getting what I'm saying. So let us now go to the interpretation of this. The company in the above illustration has inventory of 250,000 and cost of sales is 1 million. If I divide the cost of sales of 1 million by 12, I get it. It will give you a cost of sales per what? Per month. I get it now. If you give it cost of sales per month, is it that's per month now? If you multiply it by 3, that's what will give you 250,000 estimate. I get it. That means that what? The inventory holding period, I get it, is equivalent to 3 months of the what? Of the inventory. I get it. This implies an average inventory holding period of 3 months. It means that it takes 3 months for me to hold the inventory before I convert it to what? To goods. I hope I get what I'm saying now. I hope you know the way I got that 3 months. You know that 1 million naira is the what? Total annual sales. If I want to get monthly sales, I divide the 1 million naira by what? By 12. Whatever it gives me, if I multiply it by 3, that's what will give me this what? This inventory. I guess what I'm saying now. This total inventory, average inventory. That means that what? It takes me like what? 90 days. I get it now, or 91 days thereabouts. I get it for me to hold my inventory before it turns to what? To finish goods. So in your interpretation all the time, you want to interpret this 1 million, which is for annual, divided by 12. It get me for a month. I get me that per month now, you now just oppose it with the inventory. I get me, I know how many of that month will turn to this 250,000. Even for the work for the receivable, 1.2 million naira divided by 12. It give me the what? The receivables per month will be 100,000. I get me now. How many 100,000 will I have in 400,000? That's 4 times. That means that what? It takes me 4 what? It takes me what? How many months? 4 months for me to what? To receive my money from those people I sold it to. Why for the payables, you divide the 1 million, which is the purchases, and I purchase it by 12. That will give me per month of the what? Of the purchases. I guess what I'm saying now, which is 3,303. If I now want to get what is what? Once the 6,767 was payables, you now say 3,303 times 2. That gives you 2 months for me to pay back those people that I owe money. That was the interpretation of that. Yes. So it's important. So let's look at their past question in November 2014. This was the past question in November 2014 that they asked. In number 1, they said, 1A, working capital is generally understood to mean the difference between current assets and current liabilities. You know, when you move your current liability from your current asset, you have what? You have your working capital. Explain the term working capital cycle. That was the first question in that diet. That's A. B. List 5 factors that determine the working capital requirement of the firm. What are the 5 factors that determine the working capital requirement of the firm? That's how much of the working capital a firm requires. I guess what I'm saying now. We want to list the 5 factors that determine the working capital requirement of the firm. See, so Glory Limited has provided you with the following data. Look at data provided by Glory Limited regarding next year's budget that has just been presented to the board by the financial controller of the company. Let's look at the projected average amount outstanding. And look at this. Projected average amount outstanding. Look at the inventory. Raw material is what? 480,000. Work in progress is what? 360,000. Finished goods is what? 244,000. That's the inventory. Can you now see they are able to break this inventory now? Inventory holding period into raw materials, work in progress, and finished goods. As I said earlier, examiner in this question broke it down. You should be able to know that. Now, why receivables are what? 600,000 naira? Why payables is what? 422,400 naira. The budgeted working capital, you know, you had the current assets, which is inventory and receivables together. You less the payable, you get the working capital. And you are told the following are available daily averages. So far, you are giving you a daily averages of this data. You don't need to multiply by what? By 365 again. But assuming what you are given here are annual cost of sales, annual revenue, annual purchases, then whatever you get after you have computed, that was when you now multiply by 365 days. Don't forget, this one, they estimated this is in what? In days. The following are available daily averages, no annual averages. Assuming it was annual, like the other example we gave, You just divide whatever you have by that Okay, sorry. We had a slight issue with the network. So thank you. Had a slight issue. Let me continue by screen sharing again. Let's see if we can screen share again. Okay. Let's um, let's continue, please. Hope we still have our participant there. Okay. Sorry, the network. Sorry. Now, as I was explaining the other time, now they gave us these informations. We explained that Glory Limited has provided you with the following data recording next. So as I was saying, I said all this information are given in days, so you don't need to convert it to multiply by 365 again, unless this revenue, cost of sales, and purchase of raw materials are given in years. That's when you now multiply your answer by 365. This is important for you to know that you are required to compute the working capital cycle based on the above figures. So how do we now compute the working capital cycle? Let's start with the theory they put in there. You see, look, we are solving November 2014 question. It's on one. Now, working capital cycle is the total length of time. I told you it's measured in time. Total length of time between investing cash in paying for raw material. That's when you pay for the what? For your suppliers, those people that supply you flour at the start of the production process, and its recovery at the end of the collection of cash from receivables. It means that that period between when you pay your supplier and when you receive your money from your creditors and from your debtors, that's a working capital cycle. And I told you the implication of this working capital cycle for a business owner. It helps him was in managing the working capital very well. Most importantly, managing your receivables, your payables, your inventory, your cash is very key. Now, I explained two scenarios for you last time: the Gidopedia and what the Shoprite. Yeah, their working capital cycle differs. Now, let's look at it. Determinants of working capital requirement. What are those things that determines the working capital requirement? Now, those things that determine how much of the working capital do you need as a company or business per time. How much do you keep per time? Now, it's more of your production cycle. That's what. How many days does it take you to start your production process and complete it? It will tell us more about how much of the working capital you will need. Nature of the business, I explained to you, but that is different from the world Shoprite. So they will need different working capital cycle. Technology and manufacturing policy. The technology will speed up production process, and the more the technology you have, the more impact it will have on your working capital cycle. Credit policy. What's the credit policy you are getting from your suppliers? All this is also very key. Size of the firm, how small, how big, will also determine how much of the working capital you need for time. Credit granted to by supplier, now this credit policy is what credits you are giving to your buyer, your debtors. What's the policy like? How many days are you giving them for them to pay off their debt and so on? Why the credit granted by supplier is what how much credit period is granted by the producer supplier of those items. Business fluctuations, that's the business cycle thing. The fluctuation in business will also warrant us having what varying vagaries of working capital requirements. And also sales and demand condition. The equilibrating mechanisms of demand and supply can also affect the working capital, and also affect the equilibrating mechanism of the demand and supply, and also affect the working capital cycle. Operating efficiency. How efficient are you in your operations? How you are getting is also very key, and what price level changes. Inflation can also play a major key in this. So please note those determinants. Then let us now look at how do you now compose the working capital cycle. I told you when you are given information of that inventory holding period, those three items of the inventory holding period, you need to consider them as the element of the inventory holding period, and you compute for them separately. I hope you are getting me now. So, but if you are not giving those items, I said initially that if you're not giving the items, you are just giving the inventory holding period. So be it. Just use the inventory holding period and you're good. You get me now? Let's look at it. Computation of working capital cycle. Computation of working capital cycle. Now let's look at it. You are given those items. You have raw materials, you have work in progress, you have finished goods. All these three are part of the what? Inventory holding period. I hope I get what I'm saying. All these are part of the inventory holding period. Now, sorry, I want to now, I'm sorry. Now, let's look at it. So I want to hold my calculator to have my calculator with me. Now, let's look at it. The raw materials now. To get the raw materials period now, what's the raw materials period? Now, the raw materials period is raw material stocks over daily purchases. Over daily purchases. Now, you know, they give us a daily purchases here. You can see the daily purchases in the question. It's not annual purchases. How much is the daily purchases here? You can see purchase of raw material. You know, the following are available daily averages. Average daily purchases is what? 3840. So far is 3840. How do you go? You now see raw material stocks over daily purchases. The raw material stock was 480,000 divided by 3,840 daily purchases. That's 125 days. Let's get the work in progress. You know, you are given a work in progress. Now, the work in progress is what? Is 360,000. You can see. Let's get the work in 360,000 over daily cost of sales. You can see the daily cost of sales was given in the question to be 7,200. You can see 7,200. That's what you now see. Now 360,000 daily cost of sales. Let me check it again. Is well, you're having a what? You're having a 3,840. Let me check that daily cost of 3,840. Purchase of raw materials. Sorry, I'm sorry, because we are actually computing work in progress. Purchase of raw materials 3,840. So it's not daily cost of sales there. I'm sorry. Let's confirm that figure. Let's confirm the figures. It will be what? There's our calculator. 360,000 divided by 3,840. 360,000 divided by 3,840. That will give you, I'm coming, 360,000 divided by 7 to, I'm sorry. So that is it's 50. Now, please, they made a mistake here. This 3,840 is not supposed to be a daily cost of sales of what of 72. What you have here is what you should have here also, because they are work in progress anyway. So it means that there was a mistake here. Please, Mr. Kennedy, please note this mistake. Now, to get the work in progress, number of days it takes you to turn the raw materials into finished goods. That's work in progress days. Work in progress over daily cost of sales. I guess daily cost of sales in the question was 72. Go and check it again. Look at it. Daily cost of sales was 772. I hope I get what I'm saying now. 72. So far it's 72. You just place it there. That's 360,000. I mean, 360,000 divided by 72. You have 50 days. Now the last thing there is finished goods now. That's finished goods inventory days. Finished goods over what daily cost of sales also, which is 772. Let's confirm using our calculator. Using that, our calculator is 244,800. You can use your calculator also. 244,800 divided by 7,200. You have what? 34 days. You know, It means that the only mistake here was what 3840. There is nothing like 3840 to only be useful in what you purchase. If you are purchasing raw materials. That's why we use purchases here. But under the work in progress and finished goods, it is what daily cost of sale, which is 72. 72 supposed to be here. If we do that, you got 50 days, 34 days, and 125 days. So look at it. The addition of these three, which is raw materials, work in progress, and finished goods, are what will give us our normal inventory holding period. If you remember very well, that we say we have one inventory holding period. If you are not given directly this two, it is the addition of those three things that are going to add together. That's raw materials, work in progress, and what finished goods. That's what will serve as your what inventory holding period. And addition of this is what this 175, this 2008. I hope you are getting 2008 days is inventory holding period. Now the receivable collection period, that's the number of days it takes you to collect your what, your debtors from your what, your money from your debtors. That's your receivables. That's receivables over daily sales. You know, they give us daily sales there also. So if you look at it, what's the receivables over daily sales? You know, the receivable was given in the question to be 600,000, and daily sales, which is revenue, is 9,240. So with that, now I can say 600,000 divided by 9,240. That will give me what, 65 days. This is the receivables collection period. So if I add the receivables collection period, I add this with the inventory. You can see the inventories. If I add it with the receivable collection period, whatever I get is 274. That means if I add 125 plus 50 plus 34 and plus 65, will give you what, 201, 270. 74. Then we now less the payables payment period. That's how many days it takes you to pay your creditors back. I hope I get what I'm saying now. So you know the number of days it takes us to pay our creditors back. It will now be payables over daily raw material purchases. Look at it. What's the payables over daily raw material? You know the payables is what, 422,400. What's the raw material purchases? Is 3,840. That's the daily raw material purchases now. The payable 422,400 divided by 3,840. So what do you now have? 422,400 divided by 3,840. You have 110. That means that the number of days it takes you to pay back your creditors. That will be deducted from 274. Then you now say 274 divided by 110 will give you 164. That is one. The 164 simply means what? That's the working capital cycle. That's what it takes. I hope I get what I'm saying now. To collect, to pay your creditors, the cycle or the period interval between paying your creditors and what and receiving was your receivables, your cash from your from your debtors. Now you can agree with me in this instance that at this point now, the working capital of very limited is how many days? 164 days, indicating that it takes about 5.5 months. But you know how many months in a year? That we have 30 months in a 30 days in a year. How many days in a year? 30 days in a month. 30 days in a month, and we have 12 months in a year. So if I have 30 days, 30 times 5.5, 30.5 is 150. Is it not? So if you divide that 164 by 30, you get 5.5. It takes an average of 5.5 months between the time the company pays for its raw materials to the time cash is received from what? From receivables. The time between when I pay my raw material, pay for my raw material, and time when I collect my money from my creditors, for my debtors, that is what it takes me 5.5 months. So you now need to consider the kind of company in which you find yourself, in which is it too high, is it too low, and so on and so forth. All this will help you to effectively manage your working capital. I hope you get what I'm saying. Like this, your working capital will be duly or effectively managed, because by so doing, by knowing the length of time it takes, it will be easier for you to plan accordingly. I get what I'm saying, and see whether you need to have more cash or more receivables, or you need to drop your receivables collection period or increase it. You need to increase your payment period or reduce it, and so on and so forth. All these decisions can be made via what? Via this working capital cycle. I hope I get what I'm saying now. So that is for what I have. That's what I have for you today on working capital. I hope you are able to get the analysis of working capital. Now, so in the exam now, this is a typical exam. This was an exam question in 2014, question 1. I guess means how they can has it. They give you that information in days. You don't need to multiply by 365 days again. It's only when you are given only annual sales, annual cost of sales. That's when you make a division. When you have your division, then you can now multiply by what? By 365 by 365 days. So that's now in the last class you asked me of difference between the cash budget and the cash flow forecast. I mean, cash budget and cash flow is forecast. Cash forecast is more of the same thing. I guess the line of difference between them is that cash budget is what is a budgeted or estimated expenditure and receipt. I get what I'm saying that have been prepared for a year or for a specific period. Usually a year. I'm sorry, for a specific period. Usually it was usually a year. I hope I get what I'm saying now. So it means that you have been able to what prepare what are the expected expenditure and income. How much are we expected to spend? How many are we expected to receive in that period? And that period will have been what you have been made in such a way that it will be all 12 months. I mean, it's always a periodic interval, 12 months. That's cash budget. But when we say your cash flow forecast or cash flow forecast is more of you are looking at that you are breaking down that expenditure. I get me now, and expected what of payment in months or in days. I get me. You are breaking it down in such a way that what are we collecting this period in this month, or it's not like budget that it has to be for a year. It is to be a monthly thing. You are able to break it down into monthly receive cash inflow or cash outflow. I hope you are getting me now, or into a daily thing, that how much is coming in this period, how much is going to go out based on this estimate you have gotten. That means that you are having a cash forecast. You are forecasting that how much is going to be received. I mean, if we break it down into minutest form, I guess me that this is 25% of this will be coming in this social time. These are cash forecast. But what for cash budget is more preparation of that estimated expenditure and revenue in month. I hope I get what I'm saying. In a year, I guess that's more of a cash project, mostly in a year. I guess so. That's that for that. So I don't know, maybe you have other questions you want to ask me. Please, you can ask me before we call it a date, please. You can ask me if you have any other questions before we call it a date. This is working capital. They set it like twice in your last in your exam, twice in the last syllabus. I get seminar. So it's not difficult. Even the theoretical part of it, you should be able to memorize them. The theoretical part of it, that the working capital cycle length and the definition and the determination of the working capital requirement. What are those things that inform or determine how much is the working capital per time? All these are what are part of what we are discussing under working capital. So I don't know, maybe you have any other questions that we need to look at. I guess so. By next class, hopefully, I'm looking at going into variance analysis. I hope we'll be able to move into variance as much as possible, because it's very important to look at that variance. It's a topic that they just newly added to your syllabus, and I know the examiner can come from that area and use it to punish students that refuse to learn the variance analysis. It's a very simple topic. I guess what I'm saying now, I will try as much as possible to see if it happens to be the one I will have to take in the next class, so that we can have a very good understanding of it. I hope I can see me now. So I don't know, maybe you have any questions. If you have any question, you can post it before we call it a day. Okay. It means that we really understood the class. Oh, yeah, that means that at least you have an idea of what we're actually talking in the class. I guess so. Okay. With that, let's meet the next class first. I pray by God's grace, by next class, we'll have more time to what to look into the variance analysis. But if it is not variance, I will let you know. I will send a note ahead. Thank you for this. Thank you. So I will need to stop I've stopped screen sharing now. So I need to call it a wrap today. Thank you, my host. Thank you, everybody. Thank you, Mr. Kennedy Olusesan, for your DJ.
Thank
I
you,
appreciate
sir.
you. Thank you, sir. Thank you, sir. Yes, sir. Yes, sir. Thank you, sir. Good night, sir. Yeah.
Yeah, good night.
Yes, sir.